Welcome to my live broadcast of Crowdfunding Pros and Cons. I'm Karen Rands, the best-selling author of Inside Secrets to Angel Investing. My website is karenrands.co. You can get access to all my different podcasts and blogs and content, and go to Amazon and get the book. And that's pretty much all I'm going to say about that, because I am the best-selling author and the leading teacher of angel investing in the United States. And I prepared this presentation for a group of an angel group here in Atlanta, because one of the things that, as I ran my angel group, the Network of Business Angels and Investors, for many years, and when crowdfunding first started coming out, there was a lot of uncertainty about it, a lot of fear, uncertainty, and doubt that we call FUD. And so I was asked to put together a presentation to help investors understand, active angel investors, how to reduce their risk when it comes to the integration of crowdfunding platforms and crowdfunding methodologies with traditional angel investing. And that's what we're going to cover today. So let's jump right into it. I'm not going to spend a lot of time going through my background. I gave you a little bit of an intro. You can check me out on LinkedIn. You can go to my website. You can probably look at it here on Facebook or YouTube Live or wherever you end up watching this video, and there's lots of content about my background and my successes and track record. So let's get going. So let's take a step back in time. This is the thing that I think it's really important for investors to understand, is that how we got to where we are. Because depending on when an investor got started as an angel investor, or if they're just jumping in because of all of the buzz about crowdfunding, sometimes they don't understand what the heartburn is about. And so you have to understand that the prospects of crowdfunding is a double-edged sword. It really is. It's a razor blade that has cuts on both sides, or potentially benefits on both sides, but you really need to understand the usefulness of it as a technique. So if you look back at the origins of angel investing, we had, hopefully you can read this okay, the stock market crash of 1929, then you had the Glass-Steagall Act of 1933, the Securities Act of 1933, the Securities Exchange Act of 1934. All of this was done, the stock market crashed, because there were off-book bets in effect going on. There wasn't traceability of who was buying and who was selling in the stocks, and there was a lot of money in the marketplace that they couldn't predict. And all of a sudden, when there was a call on money, very similar to what happened with our real estate financial collapse and the modernization of the Securities Act of 1999, it triggered a lot of where we are today. And this caused this. So in order to protect investors, the SEC, the government, and the Congress passed these securities things that established the Reg D offerings, and it established the Security Exchange Commission, whose mission is to protect investors. So what happened was, the most wealthy of our community, the Rockefellers, the DuPonts, all the people that really are legacies today of the wealth that is still around. They were building our country. They were putting railroads down. They were titans of industry, and they were building all of this. And a lot of how they did it was being able to invest in each other's businesses, invest in these projects as they go forward. And they went to Congress and to the SEC and said, look, we want to continue to do this. We want to be able to continue to invest in the growth of America, but we need to not have it be on public display that we're doing this, because the rules for a public company is they have to disclose everything. And they wanted to be able to do this on a friend-by-friend basis, people that they knew that could come together and invest. So they did that, and they established the rules that basically meant that blue sky laws, you had to register in the states. That meant that the different states needed to know that you were doing something in their state. You need to have a prior relationship, which is what they had. And you couldn't general solicit. That's a real big difference between public companies and private companies, was that public companies, all their information is public. And when they're issuing a public stock, hence the stock market, hence IPO, the initial public offering, it's public. They general solicit, they announce, and they tell everybody that they have stock for sale. in a private company transaction, you could not general solicit. And this becomes really very important. And of course, non-compensation for non-licensed. Broker-dealers had to go through a clearinghouse, had to go through somebody that was authorized to be able to handle the exchange of public stock, right? So therefore, they could handle the exchange of private stock. They make a commission on that. Anybody that wasn't licensed to do that couldn't get a commission, because that would also potentially harm the public investors, right? Because they may not be knowledgeable, they may be deceitful, they may be all kinds of things. And to ensure public safety when it comes to investors was that anybody that handled the transaction was licensed, that they had a prior knowledge of them, or they were, and they couldn't general solicit to the public. So then how do you find investors? That became a big issue when private companies under the Reg D offerings, right? Reg D, if you recall, if you're new to it, these numbers or these particular offerings may not mean anything, but you had 504, Reg D 5, there's actually 7 within the Reg D exemptions, but a lot of them describe the process and the protocol versus the structure of the offering. So you had 504, which is the one that most people would use when they were raising $1 million or up to $5 million. They could have unaccredited investors as part of it, up to 35. So that's how a lot of times friends and family, when you were doing a private transaction, could participate. Or if you had contractors that you were giving shares in your company and they weren't accredited, you could have employees and shares of your company getting shares in your company up to 35, but you had to keep track of that. Then you had 505, which nobody used, and 506. Okay, 506 was the one where it was unlimited. You had to have accredited investors, but prior to, and we'll get to this, you had to be able to certify that you were an accredited investor. An accredited investor was the gauge in which the SEC and the regulatory bodies would measure that they had enough knowledge and wealth to be able to risk investing in private companies that didn't necessarily have a liquidity option available to them. There wasn't a way that you would be able to get your money out of those companies unless they sold the company or they went public, and then that stock was then sold to the public, and you would sell your stock to a public person. So they established these all under Reg D exemptions. That meant they were exempt from all the rules that public companies had to abide by. All right, so now we get to the Jobs Act and we talk about how that goes forward. So there were just so many barriers when it came to raising capital. So private companies, when they're starting to raise capital, they have to, up until recent history, 2012 to be exact, they had this real challenge. Who do you know? Do you know somebody that has the ability to invest in your company? Did you already know them? You can go through angel groups, and angel groups got the exemption when people would go on to Angel List or on some of these platforms and submit to an angel group to be able to present to them. And the SEC basically gave a letter to them, or established that if you had a coordinator of an angel group, then that established your connection of knowing somebody, and it was to a private group, so it wasn't general solicitation, right? So entrepreneurs are oftentimes limited by geography. Most angel groups will only invest in their geography, or they're specific to industry. That becomes important because tech is king. If you think back to, the things where a lot of liquidity came, and the whole start of the angel investing, starting back in the rise of the angel groups in the 80s, it was Microsoft, it was HP, it was a lot of these companies that were going public in the tech industry, and they created a lot of wealth from those public transactions. Those people, knowing tech, started to take that excess wealth they have and invest it in tech. And so you had the rise of them. So then the IPOs in the 90s, almost all of those were tech. Even though it might have been a pet store online, it was still technically tech because it was a e-commerce site. eBay, Amazon, all of these kinds of companies that were going public during that period of time, the crazies that created the dot-com bubble. And so all the first dot-coms were tech. So the wealth came from those, what they knew, and they reinvested. So it's not surprising, based on location, and the industry, where do we see the hot spots of investing? right? This is over $500 million comes out of the West Coast, Silicon Valley. You notice these colors. This is where most of the angel investing in the hotspots for startup, according to Fundz, Fundz.net, where they all are. So you have $500 million. This is just last year, 2015 to 2017. $300 million down in Southern California. Right? You got about $500 million up in the New York, Boston, in the Boston area, right? Atlanta, where I'm from, we got $30 million. Why is that? Because the amount of IPOs and tech companies that have come out of this area is smaller compared to where these all started back in the 1980s. That led to the 1990s. And so they've had a compounding effect. And so you have hotspots of where some of these things are where people might have retired and then they start a little angel group there and something might come out of it. But this is where it feeds upon itself and it grows upon itself. So what is important to an angel investor? Now, this is really obvious. Making money, obviously, but it's also the impact that they have creating jobs. They want to, that's where my whole phrase, the movement that I'm creating, compassionate capitalism, comes from. It's not just buying and selling stock on the stock market or buying and selling real estate or even on an ICO standpoint. It is because you're investing in something that you believe in the technology or you believe in what that entrepreneur is trying to do that's going to benefit society and create jobs, bring innovation to the market. And so it's a compassionate, a lot of times investors have to invest in technology that goes through an evolution before it actually gets to something. If you think about what we're doing now with augmented reality and virtual reality, that's decades of investments that have gone into that. Think about the travels to the moon and space travel. Decades of people investing in that to get to where we are right now. Electronic cars, decades where they may not have gotten their direct investment, but they learned from that was able to then roll into the next investment and they play it forward, but they're also investing. And those are the most wealthy that can do that. But even people that are getting started within crowdfunding or within other types of technologies, they may not have the luxury of just being able to invest for the future. So you have to understand trends and monitor to that, and that's a whole nother presentation. But so it's making more money than you can on traditional investments. The reality is that the greatest wealth in the world and in the United States is created as a result of entrepreneurism. Think of any wealthy, super wealthy person you know, always as an entrepreneur. Perhaps they were an entrepreneur that invested in real estate and they built hotels and they built this stuff, but they were still an entrepreneur. They didn't just buy and sell. That's an agent. An agent buys and sells. Somebody that invested in it as an entrepreneur, okay? And the next best way to create wealth, that's generational wealth, is to be the investor in the entrepreneur. You don't have to be the entrepreneur that incurs all the risks and works, dawn to dusk and, into the midnight hours. If you can be the investor in an entrepreneur that has the capability to succeed. That's probably the greatest secret of angel investing that hasn't been told up until in the last year or so. It was always the most wealthy that were participating in these things and benefiting from them, and then benefiting from their being bought by a bigger company or going public. And so when everybody else got a piece of the pie, after it had already grown in value, I'll break it down. You buy a share at 50 cents or $1 a share. 5 years later, 10 years later, or unless you create a different type of revenue model, that company gets bought or that company goes public. They might get bought at $10 a share. You've now made $9 for your $1 investment, a 900% return. Or they go public at $20 a share. That's a 2,000 times return. Okay? You'll never get that on real estate. You'll never get that on public stock. You might get it on ICOs, but ICOs are highly risky and there is no real value there. So you need to understand that this is where the money is made. So the sooner you understand how to do it, AKA my book with all the resource portal, the faster you can start creating wealth on it. And I want to also add this. I listened to Jason Calacanis. Everybody knows him as the big angel investor and runs all these big groups. And he has another book about angel investing, although it's not really a tutorial. He was interviewing the guy from Seed Invest, which is a crowdfunding platform. And he said he started his first business when he was 25. And of course, he's the one that, his book says how I turned 100,000 into 100 million, right? And so he learned that by being an entrepreneur and then being an investor. And he said if he knew what he knew now, when he was 25, yeah, he might have still started a business, but he would have taken a quarter of his wages or 10% of his wages every month or every quarter as he could accumulate what he needed to accumulate. And he, now that we have crowdfunding platforms, he would have put it into some startup company starting when he was 25. And he would be wealthier than he is today. Because just the law of averages, as you get more experience at making those investments and you get a little piece, even Robert Kiyosaki on Rich Dad Poor Dad, he also advocates the idea of business owning pieces of multiple businesses. That's part of the right side of the quadrant. It is a philosophy that has been promoted by the most wealthy, but most people just don't have clued into that's actually what they're talking about. So let's move on. So you got to figure out how to mitigate risk. That's what investors care about, because they can lose all that money at any point, because it is highly risky and you don't really know. So it's very easy to lose your money in angel investing if you invest on emotion and not based off of subjective, objective, criteria, right? So you got to know that the product works and can be done. That's a big thing. That's the biggest problem with most crowdfunding platforms, is that you may or may not have a product yet, right? And when I deal with entrepreneurs, I advise entrepreneurs every day, and I say this is the number one thing that investors want to know. Can that product be built? And does anybody want to buy it? Okay, how are you going to make money, right? So that's your validated market, your customers. And then there's an IP protection and barrier to entry, but sometimes it's just getting to market first is part of it. But there's also relationships you can have, channels you can have, the knowledge that the entrepreneur has. There's lots of different barriers to entry. And then what's the path to revenue and profitability is very, very important, because you'll never sell the company or go public if you can't generate revenue. And all you have to do is continue to raise capital in order to be able to sustain the operations. And part of the reasons why we have unicorns is because those companies they had a big vision, but getting to revenue to sustain their growth was really, really challenging, and they had to raise millions, hundreds of millions of dollars in order to sustain operations. And it was the investment of hundreds of millions of dollars that made them a unicorn, not because their business actually was $1 billion business. I'll let that sink in for a minute, which is one of the reasons why exits in that space are so difficult. So one of the things that a lot of wealthy people do, they shoot for the base hits. They shoot for the second base hits, right? The ones that can get bought. And I'll show you some charts on here in just a second. So the thing about valuations, this is what we're talking about. Valuation impacts how much a company raises in a round. So pre-money, most of the time, any kind of startup, if it's particularly in a tech space, it varies on other kinds of things, and it's hard to judge when you're on different kind of crowdfunding platforms. But pre-money, it's part of the forecast, part of the milestones is raising the capital. So the rule of thumb for a startup in a seed round, it's $1 million. This becomes important when, anti-dilution. Investors often look at that because they don't want to inflate a company and say that it's a $5 million, the company raises $1 million, it's a $5 million valuation, they get 20%. And then as they go to get their next round, which might be VCs, more institutional or something like that, they don't actually get, when they need the money because they didn't raise enough money, they don't actually get to a $5 million tangible valuation based off of multiple or IPs or something like that, and they have to do a down round and they get squished. That's why safe notes became popular. As long as investors, the value, remember the example I gave, you bought it at 25 cents or 50 cents or $1, and then it grows in value for when the exit has. When Amazon first started raising their capital, I just saw an article the other day that their parents put in $250,000 into that company that started. His parents started, Jeff Bezos' parents, and they're worth like $30 billion today. Well, that's because when they started, he started at 10 cents a share. And then he went to 15 cents a share. Then he went to 25 cents a share. So all those people that started on that, when he went public at $21, they all made the multiple on that. They didn't care that they only had this small percentage of a company. Who cares if you got 1% of the company? What matters is what you paid for the stock. Because the percentages goes down, it's all a matter of what the exit's going to be, which becomes the next reason why thing that people understand. The risk is crammed down. It doesn't matter as long as the value per share. I was advising an angel group out of Florida the other day, and the coordinator asked me, what's the one thing that you really want to stress to investors that they think about when they get ready to invest in a company? And it's not, yes, it's all about can they make money? It's all about do they have a product? Yes, it's about valuation and not inflating that and stuff like that. But the number one thing is where are they going to go? Who's going to buy them? What's the exit? Because when it comes to VCs, you got this big funnel of angel money. The amount of money that VCs put in companies is about 1/10 of what angels put in companies. So unless this initial funding is going to get them all the way through, this is where crowdfunding comes in. They're going to run out of money, and then they're going to struggle. But if you know where they can go to get exit and how big they have to get to be able to be bought by a private equity fund or another company so that your 50 cents a share can be $5 a share, that's a base hit. Or $2 a share, that's a base hit. And you can make a good multiple on your money to go back and reinvest in something else. And the rise of the unicorn, I talked about that. I've already talked about that. Exits become very, very difficult. We saw it with Snapchat. They go public, and then they have a hard time sustaining their model because they're not a billion-dollar business model. They got $1 billion worth of users, but until they monetize that, they're not there yet. All right. So here's the capital food chain that you need to understand. If you're not familiar with this, if you're new to angel investing, if you're new to crowdfunding investing, if you're new to any of this stuff, this might be new to you. Angel groups know this like the back of their hand. The people that have been doing angel investing for 10, 15, 5 years, whatever, okay? At a concept stage, it typically might raise $100,000 to $300,000. We call it balance sheet money. It's going to come from seed capital, founder financing, friends and family, an affinity group, and crowdfunding. And from there, they get the product done. They're ready. They got a minimal viable product. They know who their customers are. That's the idea stage. And they go to startup and early stage. They're going to raise $500,000 to $3 million in that. Sometimes called an A round. It might still be friends and family. Start the beginning of it because most angel investors that are sophisticated angel investors don't want to be first money in. They want to know that the company can raise $3 million or something like that. Angel groups, individual angels, they might do a direct public offering. That's in effect what crowdfunding, direct DPOs have been around for a while. They just got rebranded under crowdfunding and sucked up into it. Then you go to emerging growth companies. These are companies that have business, have revenues. They may not be fully profitable. They may be needing more capital because their growth is outpacing their revenues. They might have new products that they want to bring out. They may want to expand into new territories. And so they'll go to $5 million to 15 million. That's B round. Sometimes it's angel groups. Venture capital traditionally has been that space. Institutional capital like private equity funds. Unfortunately, private equity funds typically won't really deal with companies that are under 10 million in revenue and million to 2 million in EBITDA. I worked with a company that, and part of the reason why I advise companies that are in this, what I call the great capital abyss, they raise $500,000, $1 million in a friends and family angel round to start with. They get growing. They couldn't raise their other capital, so they just keep growing. They're now at $6 or $7 million in revenue. They're at $1 million. They've been putting all their money back into the company. There would be like $3 million in profit, but they got about $500,000 in EBITDA because they keep putting it into R&D. And they wake up and they say, I could be a $20 or $30 million company if I just had some capital to be able to get to that next level. And those angels are going, yeah, when am I going to get a return on my investment? Because they invested early on, but they've now been in this deal for 7 years, and the company is just chugging along. They're too big for angel groups that are looking for $1 million valuations. They're too slow for VCs, or clearly the wrong industry because they didn't invest in them right out of the gate. And they're too small for private equity funds. And they can't go to the banks because the banks don't, the banks, they don't have enough cash flow to loan them $5 million. So where do they go get money? Up until 2012, there was really no place to go get money. It was very, very difficult, needle in the haystack, to find a boutique investment firm or somebody that would put money into something like that. And typically, if they did, they wanted to come in and really impact the management team, because they wanted to take control of it. They would take majority share of it if they did. And so it's really a struggle. And there's a lot of good companies out there that fit that bill, and they're the ones that I help reach out to those investors that are new to angel investing, that normally would be a stock market investor, that see an opportunity to invest in an industry and a company that they understand that is on the downside of what they would be as a public stock, and has a huge upside potential, because you might get in at $5 a share on something like that, or $4 a share on a 506C or a Reg A Plus, but they've got potential to go to $20 a share and get bought by a private equity fund. And then that's where you go on into these rest of these ones here, right? So let's look at this, VC-backed IPOs. This is what's really important to understand, because most people think in the traditional capital formation that you go angel money, seed round, friends and family, angel money, VC money. And then ultimately you're going to have an IPO, and that's how you're going to get your return on investment. That's the traditional model. But if you look at this, the light blue number are all IPOs. The dark blue number are the ones that were VC-backed. And you can see since 2004 to 2016, significantly more IPOs that were not VC-backed than the ones that are VC-backed. It's a myth that the channel of traditional angel investing to go from angel investing to VC to IPO. That's not the most normal path in the big scheme of how money and companies are grown and the traditional model of how they go public, okay? So in a crowdfunding, back when my angel investor group, I ran it, the Network of Business Angel Investors, I ran pitch events, did giant events with hundreds of people in attendance and 20 companies pitching to private equity funds and angel investors and VCs. That was my space for a decade. And then with the recession, it got where it was hard for angel investors were very cautious. They were sitting their money on the sidelines, and most of the investors that were part of my particular group were like the ones that I work with today. They had day jobs, they ran their own companies, they had to keep their own business going. When they were during the recession, they weren't independently wealthy tech angels out of Silicon Valley. They were people that ran businesses, bought businesses, sold businesses. They were regular investor people. And so to them, on all these things, and I remember talking to other angel groups, they were like, oh, I'm crowdfunding. These inexperienced people will never do anything with crowdfunding. I wouldn't touch a crowdfunding deal with a 10-foot pole. This is just crazy stuff. And because back then it was also all just reward-based. If you remember, the Kickstarters and Indiegogos of the world back then, you bought a product in advance of it being delivered to the market, and you, in effect, help grow that company. And some investors would do that because they wanted to have a pulse on the trends and the technology that was coming to the market, but there wasn't a way to participate on it on an equity standpoint. So, rewards and donations, that was all it was. It was, their thought was, why put money into something that you can't get the benefit of it growing over time and get a return on investment? Unless you're just doing it for your own little R&D to know what's kind of out there. There were industries that you would never invest in oftentimes. I remember when I was doing research on this for a presentation I did way back then, it was 3D printers. Now 3D printers are you could say that 3D printers are around today because of the fact that so many people invested in a reward-based method. And now there's innovation that's happened, and now there's equity investments in it. But for a long time, it was just reward-based. There was probably three or four out of the top 20 companies that had raised money on Kickstarter were 3D printers. So oftentimes it's entertainment, consumer goods, fashion, toys, games, food and beverage. Guess what? Where do you see in here? Not a lot of tech. It was things that people were interested in, But they didn't know, most of those people didn't know how to invest in a private company because nobody was telling them how to, and because it was such a close-knit group of people with angel groups. You might be restricted because of geography or because of industry to be a part of it. If you go back to my map, if you weren't in one of those green circles, how would you going to invest in an angel deal to do that? And they're all tech kind of things, so why would they invest in any of these kinds of things? But there's innovation that comes along in this stuff all along, all the time, right? So the very first platform was actually in 2000. It was called Artist Share, and it was a music thing. By 2011, it was 1.5 billion being invested in reward-based crowdfunding, okay? Then the Great Recession happened. We had the banking collapse. I talked about that, the money on the sidelines, right? We had a massive job loss of income, loss of retirement funds, all kinds of things happened during the recession. And then in an effort to change that, and our Congress had the foresight, they listened to the industry. A lot of people were really committed, the real powerhouses that were committed to bringing innovation to the market and helping entrepreneur growth, that understand that the greatest source of our economic growth comes from the jobs that get created through startups. Startups grow into big companies that hire lots of people. Startups spur industries where when there's a new innovation, there becomes other industries that come into that, that sit on the sidelines of that innovation. And it has a ripple effect throughout the economy when you have strong startups. So Jump Startup, Business Startup Act, Jobs Act of 2012 sought to change that. They wanted to make it easier because they knew the biggest thing, going back to my chart from before, if you were an entrepreneur not in one of those geographies or not in one of those industries, where did you go get money? So we needed to reduce that barrier between knowing the investor, being in an industry, and being in a geography where people could find you, know you, to invest in you. This idea of reward-based crowdfunding, all the companies, billions of dollars were going into these companies that they would never get to help American people. You know, forget the rest of the world right now, but let's talk about America. People's lost their jobs, they lost their retirements. What was the best way for them to be able to share in the prosperity of economic growth through startups and these entrepreneurism? Lots of investors, angel investors, had created great wealth from it. It was clear, you know, the names, the great entrepreneurs of the world, you know, made it through that, and all their investors. You know, Microsoft made 3 million millionaires with their IPO. That was investors and employees that owned stock. So why not give the average American person a way to invest in some form of an innovation, a company that had tremendous potential for the future, and they be able to share in that and be able to create wealth for them in their retirement and make up for the losses that they had lost in the public stock markets, they had lost in real estate, and they had lost in maybe not being able to guarantee that Social Security would still be around, and we all kind of know that it's not enough. So that's the double-edged sword on this. Entrepreneurs to be able to get access to investors, but also investors to be able to access to deals. Lots of training goes into teaching entrepreneurs how to get to investors and tell their story and create a business model that succeeds and a validated business model and all the things that I've been talking about. No education exists for investors. Kauffman Foundation offers it for angel groups that are part of the Angel Capital Association, but nobody for the average published it and created the resource portal, and I only offer it for $20 because I want to create the compassionate capitalist movement. I want people to understand how to invest in companies, and I call the Jobs Act sort of the great experiment. The worst thing that can happen for it is for a lot of people that are average folks making $200,000, $300,000 a year to go put $20,000, $10,000, or somebody making $100,000 to go put $5,000 into a company because they get emotional buy-in to a video and they don't know how to evaluate them to know whether that business is validated. Even if you're investing, because now you can invest in the business down the street through the interstate exemptions. And do you know what to ask that company that's down the street that you want to invest in? The basic business things to know whether they can scale and whether they're going to have an exit. Otherwise, you might as well go to Vegas, right? So, all right. grabbing the attention of investors. I talked about 3D printers, right? Glowforge, 27.9 million reward-based in 2015. They had $45 million in sales the following year. They had equity investments of $22 million from True Ventures and Foundry Groups. They had a total of $70 million in 3 models. But they started with reward-based. Plant that. Red flag, right? So you recognize that. These are the 3D printers. They run, a few $1,000s, right? So then you have like drones. So many people have drones now. They get them for Christmas presents, all that good stuff. When they were first starting out, I remember companies coming to me that it was Department of Defense applications. It was all these industrial applications, and they were really, really expensive. Enter crowdfunding. Squadron, they raised $1.3 million from 2,300 backers. This is all reward-based, no equity, right? Then they did a follow-on $3 million investment by Living Water Investment Group the next year that got them into the commercial space, and they got them into expanding into B2B solutions. All right? You know the Hexo drone. Everybody knows that, right? They got started because of crowdfunding, reward-based. They had AR, VR headsets. I talked about this. Oculus Rift. This is a kid. He invented this, $2.4 million in 2012 on reward-based. A lot of investors did put money into that because they were into the VR space and wanted to know what the greatest tech was that was coming out and where things were going. Gamers got on board, started migrating apps to it. Then 2013, they got a $16 million valuation. They got $16 million investment plus $75 million in equity investment. And then in March, 1 year later, Facebook bought them for $2 billion. All those people right there, they all made money on that. So y'all recognize that, okay? Computerized watches, Pebble Time. A lot of people have those. $20 million in crowdfunding, reward-based, right? 2012, $100,000 investment becomes $10.3 million. In 2015, $500,000 becomes $20.3 million. 2016, $9.5 million. They ended up getting $15 million in VC funding, and 400,000 units were sold in 2014. They started to get stiff competition. They didn't stay ahead of their game. They ended up doing a downsize on that, right? And a private sale to Fitbit for about $40 million. But people that were early in did get their exits as they went through that. But y'all all know this, right? So enter the Great Recession, right? Going back to the map. So here's where we are in our income by county. So you remember the circles? They still kind of pop up, but like down here, you don't see a lot of revenue here. You know, a lot of these places where people have invested, you see a lot of green. But look at all this. There wasn't a lot of angel investor stuff in this area of the country because what? They didn't have angel groups. They didn't have, but there's a lot of wealth all over the country. If you had the ability to sell your investment to all of those people in all of those green areas, you could raise capital on a national basis. And a lot of the people perhaps in the Midwest might understand things, or up in Chicago and that stuff, that and invest in things that weren't just tech, because it's things that they particularly understand or they know or they're interested in or their hobbies. Okay, so there's been an increase in the haves and the have-nots since the recession, and as wealth creates more wealth, the jobs had evaporated. There's a lot of lack of retirement funds. We talked about that. Could crowdfunding change this? Yes, that's what our government believed. The Jobs Act had 3 goals. Update the security regs for the new data, the data world that we live in, right? Everything's online. So why would you limit an ability for a company to talk about what they're doing because it was considered public general solicitation or a public announcement if they said something online, if they did a Facebook post, if they did a tweet, if they did a press release online, if they did any of that kind of stuff? I had a client that I worked with for a while, was early on in, it was early on in doing a job portal kind of stuff, and she was very specific to ethnic groups and companies hiring ethnic groups to be able to reflect their customer base. And her lawyer, she had an interview in one of our local newspapers, and she mentioned that they were growing and raising capital. She didn't say how much. She didn't say that. He got all over her for violating a securities rule. I mean, it was really, really difficult for, and even within my things, I used to do interviews with entrepreneurs when they would come and pitch at my angel group, so I could reach out to my community and create content of my angel investor that were all over the country that would say, here, you missed this company at this event, here's their information. We would do a webinar, and we would have to be very, very strict on what they could say. We could only talk about their growth thing. We could never say they were raising capital because we didn't want to get them in trouble with the SEC. It was crazy. And in the world of digital communications, why would you limit that, to have that barrier there from something that was from 1933, right? So they needed to make it easier to find investors, remove those barriers, and give, like I said, the wealthy already playing in crowdfunding a chance at the proverbial golden egg, because they could buy stock when it's low value and get an exit when the value increases and the company's had a natural growth on that. So within the Jobs Act, both ways, entrepreneurs to investors, this is a phrase, it's a tongue twister, but remember it. Greatest opportunity for economic democratization of the capital markets. The greatest opportunity for economic democratization of the capital markets. That means that it levels the playing field between the haves and the have-nots. Everybody has potential to become wealthy in the United States if they're willing to invest in an entrepreneur and not just be an entrepreneur. Keep their day job, keep kids in their private school, continue to invest in the college education for their future, continue to do real estate investment, but carve out a portion of your portfolio and start putting it into the private equity of entrepreneurs that have a tremendous upside potential. The greatest opportunity for economic democratization of the capital markets. All right. So there's the public way for investors and entrepreneurs to connect. We have 4 ways that they can do that. Intrastate, that means a company that's located in a state can sell their equity to investors in the state. It started out, Georgia and Kansas were the first 2 to do it before the Jobs Act actually was passed. And and then now every state has some form of intrastate on their books. And in fact, it started out being just $1 million, and there was a lot of heartburn between the federal regs of securities and state regs. But then the SEC, again, with their mission to do this great opportunity for economic democratization of the capital markets and give entrepreneurs greater access to capital, they churned the Reg D 504 that I spoke of, and they changed the rules on that and made it eligible and qualified so that anybody doing intrastate is also eligible and legal under a Reg D 504. So now most states have gone up to raising $5 million. And you can do it with accredited and unaccredited investors and general solicit. So you can you could do a meetup and invite investors in. You could do a direct mail campaign to the zip code in your community and tell them that you're opening up this new business. And you could go to the Chamber of Commerce and you could announce it to the Chamber of Commerce that you're doing an investor meeting. You could do all of those things under an intrastate. You have to file. You need to make sure that you're legit on it. And there's some industries that states won't allow, but you should, that's a great way for local businesses to raise money from local investors. Buy local. Reg CF is the Reg crowdfunding. They basically took what the reward-based ones had been doing, and they made it available to people under an equity-based. Indiegogo has both rewards-based and equity-based now. I don't know if they bought the broker-dealer that did it or the broker-dealer bought them, but this was the last one of the Jobs Act to get approved because it was the trickiest for the SEC because they're allowing people of any income to participate in it. If you make under $100,000, there's some restrictions. You can't invest more than $10,000 in a year and more than $2,000 in a company. And the companies that are doing Reg CF, they can't really totally advertise. They have to do these things that they call tombstones, where they announce that they have an offering, but they can't, sell that and say inflammatory, forward-selling statements when they come out to market. It's still kind of more of a private introduction. They can do it. They just have to engage a funnel to get people to come in, and they have to be on a portal that is licensed by and approved by FINRA. FINRA is the regulatory arm that regulates all the broker dealers out there. One of the reasons why entrepreneurs had a difficult time raising capital under the old model was because broker dealers, again, back to who was licensed to sell the stock and handle the transaction, licensed broker dealers. Well, because of the nature of having to treat everybody the same, they typically would never deal with a startup, and they're also startups are risky. And FINRA, being the regulatory body of it, it's not a government agency, it's a quasi-government agency. If they put too many investors into a risky deal that didn't succeed, they would come in and get fined. So they would be like, why bother? That's one of the reasons why you don't have a lot of education out there for wealthy people to learn how to invest in private companies, because the broker dealers that should be advising them have been conditioned for decades to not talk about investing in private companies unless it's a huge $50 million private company doing some offering and getting ready to go public or something like that, and doing a private equity offering. They just don't do it. Hedge funds, raise private money, and broker dealers represent hedge funds and things like that. But when it came to upstart companies trying to get going, it was very difficult and very costly. Most broker dealers charge between $7,000 and $10,000 a month, and 10% on the back end, plus a carried interest of stock. So it's expensive to have them work for you. And so startups, early stage companies that don't have a lot of money, can't afford that. Right? So that's why, they always try these other ways to try to get stuff to happen, but they can't. So Reg CF is regulating them. So the good news to investors is that there's somebody on the hook on those companies that are fledgling, raising $1 million. Somebody's evaluating that. They typically pay, depending on the service. If they're doing a Reg CF, they might charge them $3,000 to do the valuation things. They handle all the legal paperwork for them, and then they charge 7% on the back end. If it's a cannabis thing, they can charge 8% on the back end. And that's how the Reg CF does, right? If they're doing an intrastate, a lot of the same companies that are regulated by FINRA to do Reg CF also do intrastate, and most often they don't charge anything on the front end for intrastate because it's not as regulated. They're not on the hook as much, and they don't have legal liability like they do with FINRA for the Reg CF, but they do charge a back end, and it's between 5.5% and 7% on the back end for intrastate if you go through a portal for doing that. You're not obligated to go through a portal. You have to check with your state. Some states may require you to, but a lot of companies will do a combination of these things. You can do a combination of all of these things, really. Reg D 506C was the very first one of the Jobs Act that came out. They basically took the Reg D 506 and they split it in two. 506C, you can general solicit. 506B, you cannot. 506B is still what most angel groups will do their private placement with when they're investing in a company. It's a regulated securities offering, and it's available under a 506B. With a 506B, the investors sign a piece of paper that says they're an investor. Nobody checks to see whether they're investors. It's their word that they're investors. It only becomes an issue if for some reason there's a lawsuit later on and the SEC comes in and audits and all this stuff. But the company's covered. If they got an investor to sign this paperwork, it's called the investor questionnaire, that they go in and certify, they say themselves, I'm an investor, I'm an accredited investor, then they can take their money. 506C, they have to prove that they're an accredited investor. And this is one of the things that caused a lot of traditional angel investors heartburn. They were like, I'm not going to tell you that. I'm not going to disclose that. Why would I want to tell anybody what I'm worth and all this kind of stuff? And they would have a lot because, they have sources of income from lots of different places, and they don't want the general population or the world or anybody to really know it. They just want to take my check, it clears. That's what you need to know. And so, but it's really not that bad. You can do it three ways. You can have a certified professional, somebody that's got a license, an accountant, a financial planner, wealth manager, a lawyer, can write a letter and say, this investor is an accredited investor. And then they are vouching for you, and nothing else needs to be done. The second way is same as applying for a mortgage on your home or getting a loan on anything. You put in your tax returns. And if you got W-2s, your W-2s, it shows that you have earned income and what your assets are, for doing a loan. Same sort of thing. People do it all the time. They're not paying cash for something, they're borrowing something, they got to fill out paperwork. That's all it is. The third way is, and this is the one that they got a lot of heartburn, you provide a whole reporting of your net worth and your assets and liabilities and all that kind of stuff, and that's the disclosure part that most investors have. But it's really quite simple to prove that you're an accredited investor under a 506C. And now there are clearinghouses that keep that under security, and people can go and vouch that they can go look them up, and an investor can get registered there. And it's kind of like, when you go on to, you're doing comments on a blog and you're in one of these things that everybody knows who you are, and so you don't have to sign up at every place. So there's services that offer that now. And then there's Reg A Plus. So Reg A Plus had been around for a long time as a Reg A. It's really what banks raise money for. It's what hedge funds raise money for. It's how they used it. And you basically, the big thing about Reg A was that you could raise up to $20 million. I think at that time, you could raise up to $20 million. You could test the waters and before you did it 6 months out to figure out who was going to, want to invest in it. You usually went to investment houses, and they would then also sell it, and you would gather up who your purchasers were going to be, and then you would go register in those states, back to the blue sky laws. Would register in those states, and then you would go sell your stock in those states. And that was what a Reg A was. So Reg A Plus was the first one that was the second one came out. 506C came first, Reg A Plus came second. And Reg A Plus said, well, let's separate this out. So we're going to make Reg A Plus be, you can raise money all over the country. You can raise it from anybody. Same rules kind of with the CF. If you're under 100,000, here's the most that you can do. You can invest in a given company at a time. And you can raise up to $50 million in a year. And you don't have to fill out any paperwork for Blue Sky. Now, the states had a real problem with this at first, but they just had to suck it up. It was really kind of what it came down to. So the Reg A Plus became, you have to file this, the SEC requires you to file SEC level audited financials, like an IPO, but you don't have to finish it if you don't want to, but if you do finish it, then you're a public company. NASDAQ came back with their startup emerging growth companies exchange, really for Reg A Pluses. Reg A Pluses have pretty much done away with the need for reverse mergers and pink sheets. They used to have pink sheets with your thinly traded companies, because a Reg A Plus, in effect, you get a backdoor into being a public. And existing shareholders, the ones that were the ones that invested 5 years ago, in my example I gave earlier, and you're kind of in this capital abyss, well, they can also sell their stock at the same time at whatever your strike price is for the Reg A Plus offering. So it was kind of a natural version of without all the burden of an IPO and the expense of an IPO. It's still expensive. You're still going to spend $100,000 or more, depending on how much you're trying to raise on a Reg A Plus. I mean, all of these are expensive. None of them are cheap, because instead of going to one group and paying a couple $100 to pitch to a group, or $1,000 to pitch to a group, and you got 40 a captive audience, now you have to figure out how to get 40 people to come and look at your stuff in an online environment. And so you have to spend a lot of time and money on the marketing side of things to market it. The good news is that if you go into an effective program on crowdfunding as an entrepreneur, you can grow your brand. All those companies that I used on those reward base, they spent tens of thousands, if not hundreds of thousands of dollars to raise all that money, or a significant amount of time prior to the launch to raise the money that they did. There is a method to the process of raising crowdfunding money. So from $100 in a Reg A Plus or Reg CF on up, anyone with discretionary income can invest as small as $100. And I'll give some examples of those, I think. It's not easy, and it's not without risk, right? So here's the net of it. I talked about it. Look at the chart on this. Pause it if you're watching on a replay so you can get to see, right? So you got a 506B, right? None of them require a broker. Interstate was a 504, right? So this is the whole chart of how they relate to each other. So crowdfunding becomes crowd investing. A report published in 2015 by Goldman Sachs went as far as to label crowdfunding as potentially the most disruptive of all the new models of financing, with the World Bank predicting that crowdfunding investments would be a $96 billion a year market in developing countries alone by 2025. Okay? The great economic democratization of the capital markets. Compassionate capitalism. Okay, so according to Fundly, right, there's right now $34 billion globally, $25 billion in peer-to-peer lending, $5.5 billion in reward and donation, $2.5 billion in equity. This is such a small part of it so far. There's so much potential. We are just scratching the scratch of the potential where they can go for the great economic democratization of the capital markets. 191 crowdfunding platforms in the U.S. alone. But 270,000 jobs have been created. And it's estimated to be, again, a $300 billion industry by the year 2025. It's still hard. 50% of them fail without ever getting the money. That's because build and they will come might work in the dream of fields, but it doesn't work when it comes to crowdfunding. So the thing about it, here's what comes in, geographic limits on access have been removed. The map, where angel groups are, you can go anywhere. It really leveled the playing field for minorities and women. There's New Hampshire University has the venture capital research database, and they collect stats from angel groups all over the country. And when I was active with my angel investor group, I would submit our stats to it all the time. And historically, women have been less than, I might even have the stats on here, let's see. Nope, okay, women have been less than 9% of it historically, and minority-owned companies less than 3% of all the companies that received angel capital. But in the world of crowd investing, women are more like, women-owned businesses are like, what's the number? It's like 40% of the businesses that are getting all the money they need are women-owned businesses, because women traditionally have been great storytellers. And you don't judge the entrepreneur quite as much when they're not standing up in front of you. You're judging it for the purity of what the business is and the business potential of it, because anybody can be doing the voiceover. They usually use a British sounding accent on a voiceover on a video. May or may not be the CEO, right? So you don't necessarily know. Some minority-owned companies, particularly if in some of the groups, their communication skills, if they're a tech company, if they're an Indian-owned tech company, their communication skills, they may be great at inventing and great at designing products, but when it comes to standing up in front of an audience of investors that, I'm just calling it like it is, 95% of them are white males, it becomes awkward for them. But in the crowd investing world, it's the purity of the business. Can that business succeed? There is no judgment on the entrepreneur other than what are they accomplishing, or what have they accomplished, or how good is that invention, and what is their strategy to go to market. So it's the asset class that I talked about. We talked about the regulations on the CF. You want to target raise like an escrow and aggregate as one entity. So this is when you're evaluating somebody and you're thinking about investing into the Reg CF side of things, you want to make sure that there is an amount that they're going to accumulate before they get all their money. So the inherent nature of crowdfunding platforms and Reg CF is that they have to raise a minimum amount of money before they can get their money. So you have investors have an inherent protection in that. Angel investors, when they've been traditionally working with traditional groups, a company's raising $1 million, they would have an escrow amount of $300,000, $400,000, something that would be what they would need to get to the next milestone. So you knew that if they got to that number, they could accomplish what they needed to accomplish that would move them forward and make it easier to raise the rest of the money, and also increase the odds of them becoming successful. Reg CF has that built into it. The challenge you have, depending on their growth of it, if that's all they're going to need, then that's fine. But most of the time, regular angel investors had a problem with, the reason why they had a heartburn over Reg CF or this idea of crowdfunding was that there would be 1,000 people putting $100 into a company, and they all have a voice. And when you want to direct the company, when you get sophisticated money in there, or the company needs to pivot, you may have problems with making strategic changes to the business model of the company if everybody had a voice and they're unsophisticated, or they complain because they don't understand how they're going to get their money out, and they complain to the SEC, and then the company gets all broiled into investigations and things like that. But if they invest as one entity, then they vote as one entity. They may have a block of 5% of the company, but they invest as one. And so that means the majority of them have to agree, just like when you're investing stocks in a public company and you have a voice and they send out the prospectus, and you are a one voice of many, and if you don't do your vote, it just goes into the quorum. So stock market investors can play. That's the beautiful thing. You get to look at documents. If you take the same knowledge that you do in the in-depth, if you do your own decisions on the stock market, you can turn around and invest in a Reg CF or a general solicitation company and just expect that they have the documents that you need the same way you would industry reports, complete financials, legal review, that they've got a due diligence checklist that gives you the same comfort level that you would on a public company. And then why not put some money into them that way? The problem is that a lot of companies, and the ones that don't sell, the reason why 50% of them fail, they think it's all done on a video. And sophisticated, smart investors, and what I teach in my book is, no, they have to have these things, this checklist. You have to have a discipline when you're looking at a public company to decide whether you're going to buy it, just like you have to have discipline when you're looking at a private company. So it's independent of the time and geography constraints. Any company, anywhere, people anywhere, you're never going to set eyeballs on them. And it effectively reduces risk for traditional angel investors. This is the key point of the pros and cons of this whole thing, and this is what the point I made when I developed this for an angel group here in Atlanta to deliver and train their investors on this. Because if you think about all those things that I talked about in that the flow of capital into a business, and if you look at the landscape of a life cycle of a business, so when you're at the seed stage and you're bootstrapping, you got founders, friends and family, crowdfunding, right? The whole goal of this is to create prove that your business is going to work, that you can build a product, that people are going to want to buy it, and that you know how to sell it and make money at it. Well, all of those examples I gave of the companies that had done large amounts of reward-based crowdfunding, what did they do? Without giving up any equity, they got all the money that they needed to produce a product. They had customers that validated that the product worked, and they did all that without selling equity. So I'm telling you, as an angel investor, don't be afraid. Look for the companies that have had success in reward-based crowdfunding and see if they have an equity offering, because they've already gotten to here without giving up any equity. Now, their valuation may be higher, but it's a warranted valuation because they've actually received money and sold product, even if it's not equity. It's a traditional model of what valuations are, okay? The next thing is on crowdfunding is that if you are one that has invested in an angel group that is invested in that funnel of the hundreds, thousands of businesses that have raised money from traditional angel investors raised $500,000, $1 million, $2 million, an angel round, and then they didn't go get venture capital money, and they've been growing organically, and you're like, this company, I totally believe in them. I know that they could be really successful if they just had more money. Well, go and find that CEO, find that founder, and tell them, ask them, have you thought about doing a Reg D 506C or a Reg A plus? And then come see me. Because we have a strategy on how to grow revenue and how to grow their business at the same time that they're raising capital and finding their investors. And it sits on top of your money and grows it in one entity and grows your value. And depending on how big they are, a Reg A Plus might give you the liquidity that you need, and they can go from being a regional small $5 million company to a $50 million company with national business, because people all over the country know about them and are buying their product, and their revenue naturally goes up. It costs money, it costs time, it takes a lot of effort to do that, but it's the only way that those kind of companies that are stuck in this quagmire of under $10 million in revenue have the ability to go from a $10 million to a $50 million company and raise anywhere from $5 million, $10 million to $15 million to do that and become a candidate for an acquisition and for you to get liquidity. It is the solution. You just have to understand how to fit it into what it is. So the pros and the cons. The cons are that it's not a guarantee and it costs a lot of money, just like raising regular capital does, to raise capital that way. But the pros is that it can be an integrated strategy with a growth strategy, and you have the ability to marry up. I call it the Warren Buffett model. You find your customers that want to buy your product on a massive scale. You'll find the investors that want to buy your equity, because they typically are overlapping. All right, so think about it. Reg CF is kind of like SBIR grants. Those are small business investment research that's provided by the government, and they get, and investors, notoriously, angel investors and angel groups have always loved SBIR grants because it was a way for a company to validate their product, get their product developed without giving up any equity. So when they went in, the risk was reduced as a result of that. Or university grants, when they commercialize technology that comes out of the university, and then they love that because the product's fully developed. It's got great research. They might have to pay a licensing fee back to the university for that, but it's a developed product. Well, Reg CF is like that. Reward-based is like that, okay? You can get a product developed, but the business isn't developed. You still have to do all that. So Reg CF becomes like the friends and family round. So it's a real challenge, when people, I don't know, my family member don't have any money, right? So I teach people, I have a coaching program where we teach people how to reach beyond their friends and family to raise that initial $500,000, $1 million. And so when they get beyond that, they're all betting on, will this have potential to be in the future? What's going to happen? Well, Reg CF is a lot like that, right? It's contained, it's small dollar, but it gets the company to a proven spot. And if you go to like Seed Invest, or if you go to Indiegogo and their Reg CF platform, it's really quite fascinating the kinds of companies that are receiving funds. And they might be raising $20,000 or $50,000 and they get $75,000 or $100,000 to the microbrewing area. It's really fascinating to see the innovation that's being funded through these Reg CF things. And I wish I had more time just to scroll. I probably could do that better than doing other social media and just go look at the exciting things that are happening in the Reg CF model out there. Interstate is really perfect for economic development. It's an investment from the community. Local angel groups can consider this a local syndication. If a company is presenting to you, and you could set the standards and the terms for that and operate within an interstate, and then turn around and be able to go beyond the group. That angel group typically is only going to do $100,000 to $200,000. If they're raising $1 million, you could fund that and help them host it and bring investors, potentially grow your own angel investor group, because you are helping a company that you've invested in raise money under an interstate platform to the larger community. And out of that larger community, you find accredited investors that can now be members in your angel group. It's a growth strategy for angel groups in an area to be able to do that. I mean, when I was out in California receiving the Maverick Award a while ago, I was staying with friends of mine from college that live in San Francisco, and he's the provost or the head of the dean of a private high school, and she was a licensed master electrician. And so they made good money, but not super wealthy. They're very conservative. They save their money, save for retirement. And I had taken it for granted when I came out with my book that everybody, because I'm in this space, everybody knows what angel investing is. So I told them I was out here to get this award, and it was about what I was doing with compassionate capitalism and my book and angel investing and all that stuff. And they said, "What is angel investing?" And it dawned on me, because I had not been focused on that kind of a person. Now I have a heart for that kind of person, because I really am concerned that people can get sucked into some of these investments without knowing the fundamentals of making a wise decision. So I gave them the example that says, say every Friday night, you walk down the street and you go to this restaurant that you love, you know the owner, and you try to get there early because there's always a line, or you go late because there's always a line waiting to get in. It could be 45 minutes, an hour wait to get into this restaurant. And the owner comes over to you and you say, "Oh, it's so busy." And the owner comes over and you say, "Oh yeah, and the hairdresser, the bakery, whatever, next door is closing, they're moving, and I have an opportunity to expand my restaurant into the thing next door, but I got to knock out this wall. I need to, expand the kitchen a little bit. I need to get tables. I need to hire more people, and the bank won't loan me the money because, I'm a restaurant and whatever. And I'm looking, if I get $10,000, I can, get a loan to add on to that, and I can do this, and I'm looking for my best customers to give me $1,000 a piece. 10 of my best customers give me $1,000 a piece. Oh, really? I love your place. Oh, we could, and you would own a piece of my restaurant. Now, the silent partner of the world, right? And so, that investor, because they love that restaurant, that patron, my friends, might go, "Oh, I would totally do that. Oh, who else is going to invest? Well, tell me more. Tell me more." And they might show them the plans they have and all this kind of stuff. And they wouldn't know to necessarily ask the financials and what their profit structure is, or even how to go about reading that. But what they might find out from that is that if they knew, they went through my book and they had their checklist of things to ask, they might find out that this restaurant only makes a little bit of money on every table. They might have a 15% margin on that. And so the reality is that if they just expand they're actually growing their expenses because they got more people, they got, a bigger expense in the back, they got, more potential perishable foods, and they grow in expense. They got marketing dollars now. They got all this growth in the expenses that could ultimately jeopardize their viability. So if you were smart about it, you could still do that because it still makes sense, but you might say to them, because you understood their financials and you understood basic business, you'd say, "Well, how about this? I'll invest, but here's what I want you to do. I want you to raise all your dinner entrees by $1. I want to raise all your alcohol consumption, all your things by 50 cents. And let's do that for 6 months. So, it's a $9 plate. Now it's $10. They've just grown their profit margin on that significantly. Okay. And let's see if the line holds. So if they continue to have a wait and they're making $1 a plate more, so a table of 4, they just grew their revenue by 20%. Now expanding makes sense because now they won't have a wait. They could have more because there might be people that don't come because they know there's a wait, or they only go on another night, or whatever. They would have, and I want to look and see what your numbers are on Wednesday. Let's do something that we can get more people in here on a Monday, Tuesday, and Wednesday on that would warrant having more tables. That it's not just Friday, Saturday thing. So let's do what we can do. Let's see what we can do on the marketing side. And, maybe I'll provide some money to help on the marketing side, or let's look at that first and grow your overall business. And then it makes sense to expand, right? And now you can have a piece of that business. But they need to understand that, and that's people can invest in the things they want. Here, where I am, I found out we've been wanting a long time to have a microbrew open up here. And come to find out, they raised their $5 million all from local people that wanted to invest in having a microbrew in our community. So, it's a great thing for economic development in a community, and it's great for angel groups to look at it as a way to augment their capital raise. A 506c can be a replacement for a VC because you're less likely for a cram down. VCs, will come in sometimes depending on the progress and depending on that initial valuation, which goes back to the very beginning when I talked about how angel investors really struggled with the idea of how to, the percentage of a company and part of it, and they put in these terms of no dilution and all this kind of stuff because they're worried about VCs. For those terms exist because of VCs and cram downs. The whole reason why they came out with safe notes was to get out of that until the VC round, and then the evaluation is established. But when you go to a 506c, you're telling your story, you're setting your own thing, your own story, and the people that are making that investment, given that the stock is going to be less than what they typically buy on the stock market, and there are people that are in the audience of the world, the US, and you've got all the paperwork and you got the messaging and you're growing your revenues and you're doing all those things you have to do to be successful in a crowdfunding campaign, then you get to say what your stock is worth. And the people will buy it, and it protects the investments of those angels that did the first round. And a Reg A Plus is like a private equity round, but you're not being bought out. You're growing your revenue. You can grow lots of money. You can get lots of money. You grow your revenue as part of doing it. And, it's the best way for organic companies to grow that maybe never raise capital from angels or VCs. So here's my book. I don't have my computer going, so I don't know if you've been making comments, but if you have a question that you want me to ask, then put it down under the comments underneath the YouTube thing. Please go to InsideSecretsToAngelInvesting.com.